Welcome to the Active Allocator Insights series. We hope that educational presentations such as this one will further your understanding of asset allocation and portfolio construction. In this video, we illustrate how Active Allocator can be a great way to build active investing portfolios and programs. So let's get started. At Active Allocator, we have built cutting-edge models to support fund manager selection, portfolio allocation, and market exposure hedging. We follow a simple three-step process. First, we measure alpha, in other words, skills, and beta, in other words, market exposure when a rising market tide lifts all ships, by removing biases in fund manager returns. Second, we integrate multiple information sources in creating a forecast alpha. Third, we account for unique forms of risk by penalizing managers for downside risk and integrating forecast risk into the portfolio construction process. In short, Active Allocator provides you with a mechanism to implement an active investment management strategy. The very obvious yet hard to answer question is, how should excess return be measured? Excess return relative to what? To a benchmark. Excess return over cash? Over the S&P 500? Over a sector? Or peer group? Or over a set of market factors? We distinguish between fund manager and asset class. Manager alpha, which we define as returns from traditional measures of skill, such as market timing and security selection. Asset class alpha, which we define as returns from other systematic factors uncorrelated with the benchmark. Finding a source of alpha reduces to identifying the optimal combination of skill-based returns and factor returns that is uncorrelated with the benchmark. Active Allocator has hundreds of such sources that you can choose from. Alpha is certainly uncorrelated. We all know that. The important question, however, that practitioners often ignore is how do alpha strategies add value over a traditional strategic allocation framework? Our research suggests that they create value in three ways. Leverage. The leverage provides additional return. Additional risk is limited since the alpha strategy and benchmark are uncorrelated. Wider investment opportunity set. Investors can obtain alpha exposure independently of their benchmark exposure. This creates a much broader set to choose from. Confidence. Separating alpha and beta allows investors to assign different confidence levels to each source of return. Returns from beta are fair compensation for incurring systematic risk and therefore should persist over time. Alpha includes a component based on the actions and choices of the manager that is harder to predict and may deteriorate over time. At Active Allocator, we unearth and calculate alphas properly. Then we rank them. We figure out correlations or lack of correlation across alphas. We compute alpha correlations across managers. We may, for example, compute correlations on a pairwise basis. To reduce the estimation error in these correlations, we group fund managers by strategy. Our portfolio construction system then determines the allocations by running an optimization to identify the portfolio with the highest information ratio. In other words, the highest alpha per unit of risk. Not on a historical basis, but on a projected basis. In addition, we also account for the downside risk and forecast risk of each strategy when determining allocations to multiple alpha sources. Our approach is finding the most efficient sources of excess returns and transferring them onto a benchmark. The benchmark itself can be cheaply assessed by investing in, say, tracker ETFs, for example. If properly implemented, this strategy can substantially improve returns over a benchmark. The questions we ask are, how does an alpha strategy create value? How should alpha be measured? What types of instruments are best suited to an alpha strategy? How can one implement an alpha strategy in practice? To reiterate, our process follows 3 steps which attempt to: first, estimate each manager's historical alpha and systematic betas. Second, separately forecast these characteristics, drawing partly, but not exclusively, on the historical analysis. And thirdly, build a portfolio based on these forecasts that also accounts for risk-return objectives and uncertainty in the forecasts. It ain't easy. We do realize that value of alpha investing requires both an attractive pool of managers to choose from and effective implementation. We have a multi-alpha approach, as I hope you are beginning to discover. The idea here is to create core portfolios that combine various alpha sources across a broad range of asset classes and strategies, including equities, fixed income, foreign exchange, real estate securities, commodities, and special opportunities. We have tested for around 30 classes of alpha already. Some work, others don't. We help you figure out which do. There are tons of challenges in constructing portfolios. There are no easy answers. A good place to begin is to determine allocations to managers by running an optimization to identify the portfolio with the highest information ratio, i.e., highest alpha per unit of risk, on a projected basis. In addition, we account for the downside risk and forecast risk of each strategy when you determine allocations. By identifying and measuring changing market exposures, or dynamic betas, of fund managers on a real-time basis, we are able to break down a manager's returns and risks over the long run into 3 components. Beta, the portion created by the passive average long-run market exposure. Timing alpha, the portion created by proactive variations in market exposure around the passive average exposure over time. If on average the manager increases his exposure to markets when they go up and decreases exposure to these markets when they go down, the fund manager will generate positive returns through market timing. Comparing the returns from a manager's average market exposures to the returns from the manager's time-varying market exposures can therefore help determine value added from market timing. Security selection alpha, the portion remaining or residual, which is due to security selection and stock picking skills. Active Allocator helps you structure multi-alpha portfolios. We help you arrive at projected alpha and alpha volatility for each strategy, beta exposures for each strategy, uncertainty in alpha forecasts, alpha volatility estimates and beta estimates, downside risk characteristics of each strategy's alpha, correlations across the strategy's alphas, covariance matrix for the underlying market exposures to be hedged, cost of hedging each market exposure and cost of leverage, management and incentive fees. To conclude, our approach is closely tied to active investment management, which separates passive risk, beta, from active risk, alpha. The central principles of active investment management that we use are: risk and return can be separated into passive and active components. Passive return, or beta, comes from systematic, undiversifiable risk. An investor can gain beta exposure very cheaply, and therefore should not pay active management fees for these returns. Active returns, or alphas, are generated through information asymmetry, structural inefficiency, security selection, and market timing. These returns are uncorrelated with beta. In constructing portfolios, an investor should obtain beta exposure in the cheapest manner possible, and then add alpha exposure in proportion to one's risk tolerance. Thank you for listening in.